So the next step, and this is where all the fun begins, right, which is due diligence. This is where 90% of your activities will focus. There are a handful of objectives in the due diligence process. Again, you guys all probably know what those are, right? You're trying to determine whether or not the information that you obtain indicate that there's more risk than you thought, whether the information you've obtained justifies the initial transaction consideration that you had in your letter of intent. It's an opportunity to identify issues that have to be addressed in your definitive agreement. A lot of times there may be a significant contract. It could be a customer contract. It could be a lease agreement. The seller's told you that those agreements continue to be in force. You want to make sure that you have some ability to go back after them in the event that they made a misrepresentation. So you identify those critical agreements. You make sure that they're in schedules to the definitive agreement. And if they made a misrepresentation, then you'll have the ability to go back after them under the indemnification provisions of the agreement. Perhaps the most often overlooked process is the development of an integration plan. This is the opportunity for my biggest, probably, mea culpa. So the one company that I was with was it was a roll-up, and the goal was to go public in a transaction, raise about $130 million, and immediately acquire 8 businesses for $300 million, all in one day. It was a lot of fun. So I was brought on as a consultant to help do due diligence on the targets, and we probably it took from March until September to close the transaction. So sometime around August, I was on a plane on my way home from Dallas, and remember when they had those phones in the back of the seats on the airplanes? I had to call up one of the investors to talk to him about an issue, and he said, somebody raised a question about the integration plan. Can you spend a few minutes and put together an integration plan? This was $140 million in revenues, 1,000 employees scattered over 8 different states that were all going to be rolled up at one point, and the integration plan was something that was supposed to be done on a 2-hour plane flight. But that is really what happened. Now, what do you think happened the day after I don't want to say the day after, the day of the transaction? The phone started ringing. The employees were wondering, are we going to change their benefits? Are they going to cancel their 401k plan? What does this mean to me? And we didn't have answers for all of those issues. And it was funny, when the phone started ringing, there was literally nobody assigned to take those calls. So it's that's probably the most extreme example of poor integration planning. That was driven by the nature of the investors that pulled the transaction together. That's I don't think they were necessarily all that interested in the ongoing operations. It was an opportunity to cash out. But what we commonly see is that there isn't enough time spent on integration planning during due diligence because you're dealing with all the deal issues. You have to figure out what the normalized earnings are. You have to figure out what the transaction structure will be. You have to negotiate the definitive agreement. And you don't spend enough time thinking about who are the key employees and how are we going to have a process in place to reach out to them day one. Who are the key customers and how do we have a process to reach out to them. I'll tell you that in our market right now, it's a wonderful time to be Chrysler Miller because there's so much merger activity going on in our market. And I can't tell you how many opportunities we've had where we've gone in and talked to companies and they've said, our accounting firm has gone through 1 or 2 mergers and I haven't heard from my partner in 2 or 3 months. The merger itself creates uncertainty, and then that lack of communication creates additional uncertainty that leads to customer losses. So making sure that you set aside time for integration planning during the due diligence process is critical. And we're going to get to some of the details that should be included in that. On a related note, making sure that you develop a communication plan for all the employees, the vendors, and the customers immediately to make sure that you ease any of their concerns. Questions on due diligence? This is just a list of all the potential issues that we typically see addressed during due diligence. I'm sure that you've all seen these massive due diligence checklists at some point. We tend to shy away from those. We don't like to use just boilerplate due diligence checklists because they don't necessarily reflect the value drivers in the transaction. So we like to make sure that we sit down with companies and say, okay, here's 30 pages of what you could do. What are the 15 things that are absolutely essential to this transaction? They usually deal with valuation, organizational issues, regulatory and tax compliance. Tax compliance is a huge issue. A lot of times we see companies try to pursue an asset purchase and they say, look, we'll leave behind any potential tax liability. Well, guess what? Sales tax liability may be coming along anyway. And we've had transactions where that happened. And the beauty today is most companies use information systems. So we can usually walk in and say, we hear what you say about what states you have nexus in and where you have exposure. Give us your sales data file. and we can get 2 years of sales data, slice and dice it in about a half an hour, and figure out every state they've sold in, how much they sold in those states, and where they had employees, and come back with a mathematical calculation about potential exposure. So that's something that you need to be aware of, and that's, again, it's quick, and it can result in an immediate haircut on the purchase price, which was the case in one of our recent transactions. Human capital issues, who are your key employees, operational issues that you need to address. Contractual arrangements are critical. Again, we're going to talk about stock versus asset purchases. A lot of times asset purchases result in voiding or the opportunity for the counterparty to cancel a contract. Well, if that contract was significant to you, it was a lease, a favorable lease, it was a customer contract with good pricing, it was a vendor contract with good pricing. If you step in and close a transaction, you void that contract, you may end up losing some of the economic benefit that you thought you were going to have in the transaction. IT systems, the quality of vendor and customer relationships. Go back to the sales file. You look at annual data, it may be trending in the right direction, right? Year over year, they're up. But perhaps the last 3 months, they ran into problems. They started slashing prices on transactions with their customers to increase volume. So the trend at a high level looks good, but the underlying data points in a different direction. You can get all that data during the due diligence process, and again, use some analytical tools to slice and dice it to figure out where there might be some risk. And it doesn't take a lot of effort. And most sellers, oddly enough, seem to be pretty willing to hand over that data to us during the due diligence process. The last thing is where we typically spend most of our time, which is the quality of earnings analysis. Does anybody want to take a stab at what the quality of earnings analysis involves? It's figuring out what the normalized earnings are of the company. We're going back to that formula again. You want to make sure that the income, the numerator, is reasonable in relation to the purchase price, the denominator. So a big part of that is how much income they generate. And the problem with historical results of a seller are that, well, numerous problems. One, are they GAAP or non-GAAP basis? Even if they're GAAP, there could be judgments in the application of GAAP that affect period to period. So perhaps they had reserves in the 2 years back that they released in the most recent period, and that had the effect of inflating earnings. Perhaps they have management costs or owner-related costs that they say are add-backs. They'll go away after the transaction. Well, has anybody done anything to validate that those numbers are accurate so that you get to the right level of normalized earnings? So we typically spend a lot of time there looking at accounting policies, looking at the underlying trends, looking at data, looking at customer contracts. Again, if earnings are based on a favorable lease, well, let's look at the lease agreement. Does the lease agreement include a termination provision on a change of control? If it does, we got to wave a flag. We got to take a time out and maybe restructure this transaction as a stock deal instead of an asset deal. So quality of earnings is meant to sort of bring this whole thing together and make sure that we've identified financial trends or issues that could impact the value of the transaction.